Some of the largest companies in the world, like McDonald's, trade on the stock market. In the stock market, McDonald's is known as MCD. This is the ticker symbol, meaning abbreviation for McDonald's. And some of these companies are making huge profits. Like in 2024, the McDonald's Corporation made a little bit more than $8 billion of profit. This is how much cash they had in their bank account after paying for all of their expenses. And when McDonald's makes $8 billion worth of profits, there are three things that they can do with this cash. Number one is they can save this money for an emergency. In case we enter a recession, in case we see some sort of bad things happening in the economy, they have some cash saved up. That way they don't have to go out of business immediately. Option number two is they can reinvest some of this money, because they can take this money and invest it into new hamburgers, into new locations, into new technologies to make their company more profitable and to produce a better product. Or number three, they can also just give this profit away to their investors, to people that actually own the McDonald's Corporation. And what you'll see a lot of the big companies do that have big profits is they'll do all three of these things, because they can't reinvest all this money because they're already so big. They are not interested in aggressively growing. They just want that slow and steady growth. So they'll reinvest some, but not everything. And they'll also want to save some, but they also don't want to save everything because, well, saving money is not very exciting. And that's where some of these corporations will just give this money away. And one of the ways that these corporations on the stock market give this money away is in the form of a dividend. A dividend is a cash payment that a company is going to give you for doing nothing except owning the stock. And in the stock market, generally, companies that pay out dividends will pay you a dividend every 3 months, meaning every quarter. Now, not every company is going to pay out a dividend, because not everybody has a profit, and not every company is interested in giving away that profit. But the companies that do pay out the dividends are generally paying them out every 3 months. And in order for you to qualify to receive that dividend for yourself, you have to own one of the shares of the company. So let me show you how the McDonald's Corporation works. So let's assume this pie right here represents the McDonald's Corporation. And what they do is they'll slice up the pie into many small slices called shares. And in McDonald's case, they have approximately 710 million shares of the company. So if you wanted to go out and buy the entire McDonald's Corporation, you'd have to go out and buy all 710 or so million shares. But you can go onto the stock market today and purchase one share of the McDonald's stock, so one slice of their pie, for approximately $300 per share at the time of me recording this video. Why does that matter? Because also today, at the time of me recording this video, McDonald's says that they are paying out approximately $7 in dividends a year for every share that you own. So if you go out and buy one share of the McDonald's stock, you're going to be entitled to $7 of cash flow for every share that you own. Now, to put that in perspective, there's about 710 million shares of McDonald's. Each share pays out slightly more than $7 per dividend, which means McDonald's is going to be paying right around $5 billion of dividends out this year, out of the $8 billion of profit that they generated last year. So you can see how they're going to be giving out a big chunk of these profits, and you can get your share of the profits if you own one of the shares of a company that's paying out these dividends. Now, I'm not telling you to go out and buy the McDonald's stock. I want you to understand how this works, because I'm going to give you some more specific examples in this video. And I do have to remind you that investing has risks. You are never guaranteed to make money when you invest. In fact, you will lose money at some point. So make sure you always do your own due diligence and never blindly trust a random guy on YouTube. Everything that I'm going to show you in this video is for example purposes only. I'm not telling you what to invest in. So if you buy one share of McDonald's, you'll have to spend $300 to make $7 of cash flow. If you buy 10 shares of McDonald's, that's $3,000, and it'll pay you 7 times 10, $70 of cash flow. Now, that might not sound like a lot, but you have to remember, this cash flow game is a long-term game, because you want to invest in a company that's not only growing in value, but where they're also paying you more cash flow every single year. For example, a number of years ago, the McDonald's stock was trading for around $100 a share. And at that time, around 10 years ago, the McDonald's stock was paying out around $2.80 per share, which means over the last decade, not only did the stock price grow by around 200%, but they've also increased the amount of dividends that they're paying by 150%, which means for every share that you bought years ago, not only is a share more valuable, but you're making more money out of every share that you bought years ago as well. So if you're working to accumulate more shares, not only are you getting more income because you have more shares, but each share is paying you more income year after year, assuming you buy a good asset. So let me actually break this down with some more examples. Morningstar recently published a list of their 10 best dividend stocks to buy. I'm not recommending these, I'm just showing you how to think. And the top 3 that they say are Merck, Coca-Cola, and PepsiCo. At the time of me recording this video, MRK is paying out a dividend of around 3.85%, meaning if you were to invest $100 into this stock, you're going to make $3.85 of dividends in cash flow this year alone. Coca-Cola is paying around 3% a year in dividends, and PepsiCo is paying out around 3.75% a year in dividends today. Now, if you look at these numbers by itself, you might say, my goal is cash flow. I want to invest in the biggest dividend, so clearly this is the best investment. But that's only one part of the equation, and this is why it's so important for you to understand the investment that you're making. Take a look. Over the last 5 years, the MRK stock is up by around 11%. Versus the Coca-Cola stock over the last 5 years is up around 30%, even though they're paying out a smaller dividend. So yes, today Merck is paying out a bigger dividend compared to Coca-Cola, but if we take a look at the actual stock, the actual investment over the last 5 years, Coca-Cola has way outperformed. And this is where if you can invest your money into a good stock, now you can see the value of the stock go up and see the value of your dividends go up as well, because as the share becomes more valuable, the company is probably making bigger profits, and if they're making bigger profits, they can pay you a bigger dividend as well. This is why when you invest your money for the cash flow, you have to go beyond just looking at this percentage dividend, because most people are looking at this thinking that, oh, the bigger the dividend, the better the investment. But if the investment is trash, well, now the dividends become pretty trash too, because over time those dividends get smaller if the company is making smaller profits. This is why it is so important to know how to analyze your investments instead of just blindly throwing your money into a random stock that you read on the internet, or into a random stock that a random guy on the internet told you. You need to know how to analyze your investments. Now, this is where a lot of people say something along the lines of, Jaspreet, this is cool, but now I'm starting to get a little bit overwhelmed. I don't know how to analyze a stock. I don't want to research the financials. I don't want to study what the CEO is doing. Isn't there a simple way for me to just invest for cash flow? And yes, there is, which is why number 2, we're going to talk about ETFs. So let me show you how you can get this type of cash flow without having to do all that same work. This is where ETFs come into play. An ETF is an exchange traded fund, and this is where you are investing into a basket of stocks. So what we talked about before is the value investing into an individual company. We talked about McDonald's, how McDonald's makes billions of dollars of profits, and they can give away some of these profits at the end of the year in the form of a dividend, which is cash flow that's deposited into your bank account every 3 months. Well, if you don't want to research that company or don't want to take on that additional risk, what you could do is invest into a fund, into a basket of stocks that may look something like this, where now instead of just investing in McDonald's, you invest in McDonald's, and AT&T, and Apple, and Tesla, and Coca-Cola, and Amazon, and Nike, all into this one fund. This way you don't have to find all these stocks, you just find this one fund that's giving you exposure to all of these stocks. Now, the nice thing about this is you don't have to worry about doing all that research, because in this case, if McDonald's were to go bankrupt, well, you lose your entire investment. Your investment goes down to zero. In this case, if McDonald's went bankrupt, yes, it would hurt the fund, but then the fund could automatically kick McDonald's out and replace them with a new company. Maybe they'll replace McDonald's with Chipotle. Who knows? But this is passive on your side because the fund is actively working to manage the fund, and you don't have to do any of that work. So it's less risk, but also less return. Because in this case, if McDonald's were to take over the world and now they started having these amazing burgers and everybody wants a McDonald's burger, now they're probably going to make bigger profits, and they're going to see their stock price go up and their dividends go up, which means in this case, you would benefit because you're getting all the gains. Here, if McDonald's took over the world, well, it's going to be balanced out by some of the losers in the fund. So you have to understand that this comes with less risk, but also less potential return. Now, there are many different types of funds out there. You can invest in funds that give you exposure to the stock market. There are AI funds, healthcare funds, real estate funds. For the purpose of this example in this video, let's talk specifically on dividend-paying funds, which are focused on providing income and stable income for you. I'm going to go over 4 different types of examples. Again, these are just examples. I'm not telling you what to invest in, but example number 1 is NOBL Noble. This is an ETF that gives you exposure to the S&P 500 dividend-paying aristocrats. What that means is, number 1, to qualify to be in this fund, you have to be a part of the S&P 500. That's a group of the 500 largest companies in the stock market. Then layer 2 is you have to be a dividend-paying company. So you have the 500 largest companies in the stock market, but not all of them are paying out a dividend. And then number 3 is you have to be a dividend aristocrat, meaning not only do you have to be in the S&P 500, not only do you have to pay out a dividend, but you must have also increased your dividend every year for at least the last 25 years. So this is a very exclusive club focusing on the very large companies that have a strong track record of not just paying out a dividend, but also increasing their dividend for decades. At the time I'm recording this video, NOBL is paying out a dividend of around 2% a year. Example number 2 is SCHD. This is an ETF created by Schwab. Schwab is a fund manager, and this is focused on investing in high dividend paying companies inside of the United States. So, at the time of recording this video, SCHD is paying out around 3.75% a year. It's not as rigorous as Noble, but this is investing in the larger companies in the United States that are paying out higher dividends. As a disclaimer, I am personally invested in SCHD. Example number 3 is VIG. This is an ETF created by Vanguard, another fund manager that focuses on appreciating dividend companies. So, VIG is looking for the companies that are the larger, more established companies that are focused in on increasing how much money they're paying out in dividends year after year. VIG at the time of recording this video is paying out around 1.6% a year. And then last but not least is VYMI, another fund that I'm personally invested in. As a disclaimer, this is also created by Vanguard, but this is investing in international companies that are not in the United States that have a track record of paying out strong dividends. So this gives you some diversification outside of the United States. But there's also more risk, because not only do you have the company risk, but now you also have the country risk, because some of these countries are not as established. They don't have as strong of a military. They don't have as strong of an economy, but the company and the country is looking to grow. At the time of recording this video, VYMI is paying out around 4% a year in dividends, but also potential for higher growth and higher returns on the dividend side as well. Hear these numbers, you might say, well, Jaspreet, this doesn't sound like a whole lot. But the way that you win in this game, again, is by number 1, finding a good investment. And what do I mean by a good investment? Something where the asset price will go up and they're gonna pay you more dividends, because the goal is the shares that you buy today are gonna pay you more income next year. They're gonna pay you more income the year after that, and even more the year after that. So you want to own these investments for the long term. Number 2 is every year you want to consistently buy more of those shares that are paying you that cash flow. I have a system personally where every week money is leaving my checkings account and is being invested into my portfolio of funds. So I'm always working to acquire more shares that are paying me more income. I do it every week, whether markets are up or down. I don't care what's happening in the economy. I don't care what's happening in the geopolitical world. Every week that's happening. If you enjoyed this clip and you want to continue your financial education journey, I have another video that I think you'll love. All you got to do is click that button right over there. And for those of you who want to stay up to date on the top finance and business news, you can join Market Briefs, my free financial newsletter, by clicking that button below. Thank you for watching, and I'll see you in the next one.